Olá, estamos de volta para o último painel do dia e um painel muito especial. Como é um painel internacional, lembro a vocês que na sala principal do nosso evento nós temos a tradução simultânea. Caso prefira ouvir o áudio original, tem ali a sala aberta com essa opção que você pode acessar através do nosso lobby virtual. Nós teremos agora um painel muito especial, como eu disse, com Howard Marks, co-chairman da Oaktree e um dos maiores gestores de fundos de investimentos do mundo. Howard vai falar sobre como navegar em ciclos de mercado. E para mediar a nossa conversa, recebemos mais uma vez a diretora de Investment Solutions da TAG Investimentos, Francisca Brasileiro. Howard, welcome to TAG Summit 2021. It's a pleasure to have you with us. Francisca, mais uma vez, obrigada. Agora com vocês.
Thank you. Well, thank you, Howard. I can't express how honored we are with your presence here today. For us, it's particularly important because as an asset allocators, we are always trying to masterize in the market cycles. So your lessons and letter are really a good, great guide to it. Actually, exactly 3 years ago, I gave a speech inspired not in your last book, but in the most important things still illuminated. And it is still, until today, my most praised speech ever. But at that moment, I was talking about how as a country of very high yields, we're not used to adapt our asset allocation models to the market cycles. We're always looking to the past. And now we are facing one of the most challenged periods for long-term investors in Brazil. For the first time, we are dealing with negative yields, -6 real yields exposed, actually, and at the same time in the middle of the pandemic crisis. So your lessons from mastering the market cycles is more important than ever because we need to try to understand what risks we need to avoid at the same time that identify the risks we need to take more than ever. So looking forward to it.
Well, I'm very glad to be with you today. And we have, believe it or not, a similar situation in the United States, which is quite unusual because our 10-year Treasury yields 1.2, and inflation in the last 3 months has been running over 5. So we also have negative real returns of roughly 4%.
Yeah, I think it's one of the most challenged periods that all of us have lived, this odd era, actually. Well, I try to start it for, I think that the most important theme today. We can't avoid talking about inflation, reflation, or so. As in your last letter, you talk about it. I try to quote a little bit of it and also hear a little bit for you. In your last letter, you reinforced that should not have the illusion that we can preview the future. Quoting Taiwan, it may be hard to admit to ourselves and to others that you don't know what the macro future holds. But in areas entailing great uncertainty, agnosticism is probably wiser than self-delusion. But you also reminded us that we need to be aware of macroeconomics. And it's impossible to talk about it without mentioning the transitory or permanent behavior of inflation. So I can't stop myself from asking you to share your thoughts about it with us. Not actually predicting the future, but trying to put some light on how can the two scenarios can impact the financial assets.
Yes. Thank you. Thank you for the opportunity to answer that question. I start the memo which came out last Thursday, by quoting Warren Buffett. And we were having dinner together 5 years ago, and he said for a piece of information to be desirable, it has to satisfy 2 criteria. It has to be important, and it has to be knowable. Now, macro, and specifically your question about inflation, is very important, but not knowable. And as I say, and as you said in your question, we have to be realistic. when we ask whether we can add value by answering a certain question, and as a result, whether that answer to the question should be included in our investment process. Now people say that the macro is extremely important. As you say, this question about inflation today, whether it's going to be transitory or with us for a long time, is extremely important. How can you ignore it? How can you not take a stand on that issue? Well, I understand all that, but the question is the answer knowable? Is it possible to know the answer? Now, in America, football games begin with the toss of a coin. And the toss of the coin determines which team has the ball at the beginning. So if I said to you, I believe it's going to be heads, and you say, no, tails. I say, well, will you bet me on that? That's the question. We all have opinions. The question is, will you bet on your opinion? And if you'll put up $3, I'll put up $2. Well, you say, I'm not confident enough to give you odds. Well, then you must not believe what you're saying. And that's the position that I take with regard to most macro questions. I may have an opinion, but I don't believe that I'm right. And it's one thing to have an opinion, and it's something very different to believe that you are certainly correct and bet heavily on your opinion, which I don't do. Now, you've asked about inflation. And as I mentioned, we've been seeing inflation of more than 5% in the last few months. The question is it going to subside in a year or so? Or is it going to be with us for 5 years or more? The answer to that question is very significant, even if, in my opinion, it's not knowable. There are arguments on both sides. Of course, if there weren't arguments on both sides, life would be easy. But the people who think it's transitory, that is, the people who think it will be with us for a short time, point to, number one, the difficulty in restarting the economy, and the fact that it doesn't start off smoothly when we come out of the lockdown. And as a result, there are shortages of certain parts, lumber, housing, used cars. And when the demand exceeds the supply because of a shortage, then the price goes up. But is it going to stay up, or is it for the short term? Then another question is, in 2020 in our country, we had an unusual event. The government gave out so much money that many people, they gave out money to roughly 80% of the population, received a check from the government. If you hadn't lost your job, if you still had your job, you're still working, you're still getting paid, and you received the check from the government, that means you made more money in 2020 than in 2019. And 2020 was the best year in 20 years for disposable income. So many people had a bulge, above trend income. In addition, you couldn't spend money. You couldn't go to a store. You couldn't go on vacation. You couldn't have a wedding. You couldn't go to a sports event or a concert. Many things you couldn't do. So you got more money than usual, and it piled up in the bank. And the combined effect has been estimated at $2 trillion. So now people are spending that money. They have money built up, but they also have desire built up. And they are spending the money. So we have an unusual bulge in consumer spending. At the same time, we have some shortages. And the combination has resulted in high inflation. Those things will reverse or slow down. And that's the position of the people who believe that our inflation is transitory. Then there are people who believe it's going to be with us for the long term. The reason being that the government is spending so much money without regard to raising that money through taxes. It's running huge deficits. It is what we call printing money, although that's a figurative description, not literal, but it's putting so much money into the system to cover the deficits that this will result in a long-term bout of inflation. Too much money in the system, too much economic activity. So, you know, there are people who on each side. By the way, there are intelligent people on both sides of the argument. And I conclude that there's no such thing as knowing the answer. By the way, at this point, as we sit here in August of 2021, there may not be an answer. By which I mean all of the events which will determine the future have not taken place yet, have not been determined. So we can't know what events will take place. We certainly can't tell now whether the inflation will be temporary or permanent. What do you do about it? What is the impact? Well, clearly, if we believe that if the inflation turns out to be with us for many years, that will make interest rates rise, number one, so that net real rates after loss of purchasing power will be positive. And number two, because of the strength of the economy. There is so much demand, so much economic activity. And so then that means interest rates will rise. When interest rates rise, the demanded return on investment rises to keep pace. And when the demanded return rises, the way the market provides an increased return is by cutting the price. So the normal expectation is that inflation produces higher interest rates and lower asset prices. And an investor with a portfolio today might want to do something about it. On the other hand, if the inflation is short-term and is going to subside, then we don't have to worry too much about an increase in interest rates and a decrease in asset prices, and you can hold on to the portfolio you have now. As I say, I think that the question, which is it, is unanswerable. But the one thing I'm pretty sure of is interest rates are not going to go down from here. Inflation may come down, but interest rates are not going to go down. Interest rates will either hold where they are or rise, in which case most investors will want to have some inflation protective assets. I don't believe anybody should go out and sell everything they have and buy inflation protected assets, but they may want to do some changing at the margin. What would you buy if you thought we were heading for inflation? Inflation protected bonds, and there are inflation protected bonds. The US equivalent is called TIPS. Number two, debt securities with floating interest rates. Number three, maybe some real estate where you can pass on the inflation in increased rents and negate the negative impact of inflation. Number four, you invest in companies where they have the ability to pass on price increases or increases in their cost of doing business to the consumer in the form of price increases and balance out the inflation. Number five, companies that grow fast enough to produce a total return even as valuation multiples come down. So there are things you can do. I think it's probably makes sense for people to do a little. I think nobody should do a lot, but a lot of it is based on each person's opinion and personal taste.
Perfect. I'm glad to hear that because we are kind of doing the same thing, buying inflation-linked bonds here in Brazil and trying to look for the real assets.
Right.
Well, not with so much confidence because, as I said, it's really hard to predict Well, it's always, but I think that now it's even harder. Well, let's have our final minutes to hear, I think that's the most important part. We are talking about the inflation challenges we are all facing and how does it impact the fixed income markets, the credit markets, the spreads, and so on. But we're asking Howard how he managed to do it, how dealing with it without losing the focus on companies. So Howard, if you can talk a little bit about it to us and join with what strategies you have been adopting to the portfolios, it would be great.
Well, I don't know how much of the previous answer your clients heard, but as I mentioned, we're not top-down investors. We do not direct our investments on the basis of the macro outlook because we don't feel we can add any value in knowing better than others what the macro outlook is. We are bottoms-up investors. We're at all times looking for investments that have a good return potential, a limited amount of risk, and the best ratio of return to risk. And we are, the number one emphasis, Francisca, in our investment approach is risk control. And so, we emphasize limiting the downside potential. Our best competitive years often come in the bad times. So, our clients, I started investing in high yield bonds, for example, 43 years ago in 1978 at Citibank. And that was the beginning of the high yield bond world. And the clients that I met wanted to participate in the high yield bond sector, but didn't want the full risk. So we have always strived to deliver a portfolio that has good return potential, but will resist declines or reduce declines in bad times. I believe that is an accurate description of what we have delivered in all of our strategies, and I think our clients are happy with that. So, we try to garner the market returns, maybe even a little more in the good times. And in the good times, everybody makes lots of money. And I don't think it's important to outperform in the good times because the returns for everybody are very good. But then in the bad times, our clients have been somewhat protected from the full fluctuations. It's in the bad times, I think, that it's important to outperform. And historically, we have delivered outperformance. So, to oversimplify, I think we give average results in the good time, which are very good, and smaller than average losses in the bad time, which is when people want outperformance. And the combination, if we can do that, is above average returns over a full cycle, below average risk, below average fluctuations, outperformance in the bad times. I think that produces happy clients. And I think it's a good model for managing money. Not everybody manages money that way. Not everybody wants what we offer. Some people say, no, in the good times, I want to have maximization. I want to be sure that in the good times, I'll have the highest returns of anybody. Other people will deliver that. Now, if that's your rule, then I imagine you'll also have poor returns in the bad times. You'll have above average susceptibility to the declines. Other people manage money that way. Big ups, big downs. Our clients don't want it. And so we stress risk control, and I think we'll continue to do that.
Perfect. Well, I have a last question that I think that's also very important. And we're talking about cycles and valuations on asset classes and so on. We can say that this was the fastest crisis ever with a very quick recovery. But we're still in the beginning of it, actually. But by the other side, market fundamentals would imply that we are in a mid to late stage of the cycle, with equity markets at their peaks, stocks valuations and multipliers at their highs, and spread at their minimum. So, as you said, skyrocket prices. However, we're still in the middle of the health crisis, with a lot of uncertainty and a lot of stimulus that you need to face a tapering soon. In this context, can we identify if the prices are fair enough or if they are maybe too high? In other words, can we buy this market optimist, or should we be prepared to an expected early crisis, also the fastest cycle ever, and changing our asset allocation sooner than we were supposed to?
Well, as with most things in investing, the answer is not easy. We had, as you indicate, the briefest crisis in history. On February 19th, stocks, the S&P 500 reached its high of roughly 3,300. 33 days later, on March 23rd, it was at its low of 2,200. It was down 1/3. But from March 23rd, it has gone straight up and more than doubled, and keeps hitting new highs every day. So very brief crisis. But one of the reasons is that we had the briefest recession in history, only a couple of months. Many recessions go 6 months, 9 months, etc. This was 2 or 3 months. And we had a strong comeback in the economy as well. Of course, this was due to the government and Fed actions, which were the strongest in history. And the Fed and the government did things in a matter of weeks that in the last crisis, the global financial crisis of 2008, took several months. So all very compressed in time. Now, as you indicate, stock prices are high, prospective returns are low. Are we in the late stages of a cycle? Well, there are many different cycles. Normally, the economic cycle and the stock market cycle move similarly, not exactly in parallel, but similarly. They go up and they come down roughly together. And usually the peak in the stock market rises on good economic news, and then the peak of the stock market is roughly simultaneous with the peak in the economy. Maybe there's a few month lead or lag. It's not exactly, these things are not mechanical, but usually the high in the stock market is roughly synchronous with the high in the economy. Your question, it's indicative of the norm in investing because there are more than one answer. So we could say, Francisca, the bad news is that the economy is still somewhat low. The pandemic is still going on, although better. And yet we have stock prices that are very high, dangerous. Okay. But also you can say it another way, which is, yes, stock prices are high, but the good news is that the economy is closer to the beginning of an upcycle than to the end. So normally when stock prices are very high, the economy doesn't have much further to go. Today, stock prices are high, but the economy will probably rise for several more years. So that's the good news. You can look at it either way. I personally feel that, yes, asset prices are high. And normally, given the high asset prices and the aggressive behavior that investors are engaging in and the signs of risk in the market, normally those things would be enough to get me to want to cut my risk. But I've never seen those conditions at the beginning of an economic cycle. And I believe we're going to have good economic news for at least 1 more year. We may have positive economic growth for 5 years. And so I'd rather invest in low prices. I can't arrange that, though. I can't control the environment. I have to deal with the high prices we have. And with the positive economic outlook, I think they're not too bad. So I argue in the memo, I hope your audience will read my memo of last week, thinking about macro. I take a roughly neutral position today, not aggressive, certainly not more aggressive than my usual, but not too much more defensive than my usual. I'm a little biased toward defense because of the inflation concerns, but other than that, fairly neutral. And I think that's the right one.
Perfect. Move with cautions. I think that's a good phrase to have in mind. Howard, from your last minutes, we are already ahead of our time, but I can't stop in asking if you have some lesson. Investment process has changed a little, I guess, since you're the most important thing. You have add a lot of things in your last book as well. These both I'm very aware of. But I was asking myself, is there anything you can add to this odd area that you are living, or for us investors in Brazil facing for the first time the real challenging of adding returns with small interest rates, low interest rates. So anything you can add to us will be valuable.
Charlie Munger, Warren Buffett's partner, said to me around the time I was writing The Most Important Thing, none of this is meant to be easy, and anybody who thinks it's easy is stupid. It can't be easy to make money. Everybody wants to make money. Everybody wants to get rich. So that process is very competitive. And the fight for investment returns is very spirited. And so with all these other people, intelligent, computerized, highly motivated, hardworking, with all these people trying to make money, it can't be so easy for you. You must have reasonable expectations. And when I brought out The Most Important Thing Illuminated, the second edition, I added a chapter, I think it was number 21, which says the most important thing is reasonable expectations. You can hope to make 5% or 10%, or if you're lucky, 15% in the markets. But if somebody comes and says, oh, I have a surefire way to double your money, triple your money, and make 50% a year, you should be skeptical, because they don't give away opportunities like that. And if somebody says, I have a way to double your money, I would say, well, why is he giving this to me? Why do I receive this gift? Why isn't he doing it? And the answer is usually too good to be true. So I think that your audience must not have their head turned by promises of get rich quick. The goal in investing is to get rich slow. And once you're rich, to stay rich and not give it back. And so I would stress being realistic, that it's not easy, that it involves risk, and that expectations must be reasonable. And, in investing, it's nice to have a good asset allocation. It's nice to have capable asset managers. It's nice to make good decisions when to get in and when to get out. But it's not easy. The most important thing in investing is to invest now, invest a sum that you can spare from your everyday life, take on an amount of risk and especially illiquidity that you'll be able to live with in the bad times. Because the worst thing you can do is invest now and then fall on bad times and take your money out at the bottom. The goal should be to invest now, invest continuously, hold for the long term, and the way markets work, if you do that, and if you hold for 20, 30, 40 years, you will most certainly make money. You might try to get more money by getting in at the right time and out at the right time, by buying the right securities now, by buying other securities later, et cetera, by having more risk sometimes, less risk other times. You can try those things the way I do. But for most people, the most important thing is invest, stay invested for the long term, and don't mess up the process by being hyperactive. That's my overall advice to your audience.
Perfect, so perfect for this moment. Well, forever. We stay attached to our investment process. Let's not forget that, guys. Well, Howard, I'm really, really thankful for having you here with us. Thank you for sharing your knowledge with us, not only now, but always as you have been done. Thank for Oaktree, for Itajubá that helped us making it happen. And I really hope to have you again with us another time without in the technical issues. So it's our invitation here. Thank you very much.
Thank you. Well, I look forward to returning, and I'm very interested in Brazil, and I enjoy my partnership with you and your firm. I look forward to the future together.
Thank you, Vanessa.
Thank you very much. Francisca, mais uma vez, muito obrigada, prazer tê-la conosco por essa moderação. E amanhã tem mais. Bom, pessoal, por hoje é só, nós vamos ficar por aqui, na certeza que nós nos encontraremos amanhã, a partir das 11h15 da manhã, para mais uma imersão intensa sobre gestão dos investimentos. Agradecemos a todos os patrocinadores que contribuíram para a realização do nosso evento e principalmente a vocês que estiveram conosco durante todo o dia. Espero que vocês tenham aproveitado e curtido muito todo o conteúdo que foi debatido e trazido aqui para vocês com muito carinho. Tenham todos uma ótima noite e até amanhã. Tchau, tchau.